Have you ever wondered why your paycheck feels like it buys less every year? Or why that house you wanted suddenly costs twice as much as it did 5 years ago? You probably blamed yourself. Thought you should have worked harder, saved more, been smarter with money. But here's what nobody tells you. There's an organization that influences almost every financial decision in your life, and most people have no idea it even exists. Here at Simple Money, we've spent years breaking down how the financial system really works. And today, I'm going to show you how the Federal Reserve, an institution most people have never thought about, quietly controls your financial reality. Because once you see this, everything about your money situation will suddenly make sense. Here's what's really happening right now. While you're working your job, making your budget, trying to save for the future, there's a group of people meeting in Washington deciding things that will directly impact your life. Your ability to buy a home, your job security, how much your groceries cost, even whether your savings grow or shrink. They're not elected. You can't vote them out. Most people couldn't name a single person on this committee if their life depended on it. And yet, they have more influence over your financial well-being than almost anyone else in the country. This organization is called the Federal Reserve, the Fed for short, and it operates in the shadows of the economy, pulling levers that ripple through your daily life in ways you've probably never connected. Think of the economy like a massive machine. You're inside it, working, spending, saving, trying to get ahead. But what you don't realize is that someone is controlling the speed of that machine, speeding it up, slowing it down. And you're just trying not to fall off. That someone is the Fed. Now, you might have heard the name before, maybe in a news headline you scrolled past. But here's the thing, most people have no idea what the Fed actually does, and that ignorance costs them dearly. Because the Fed's decisions determine whether you can afford to buy a house, whether your job will still exist next year, whether your carefully saved money will be worth anything by the time you retire. And it all happens through mechanisms so subtle, so indirect, that you never see the connection. Let me show you exactly how this works. First, there's what I call the interest rate puppet strings. This is the Fed's main tool for controlling the economy, and it's devastatingly effective. Here's how it works. The Fed controls something called the federal funds rate. This is basically the interest rate that banks charge each other for overnight loans. Sounds boring, right? Like something that has nothing to do with you. But here's where it gets interesting. That one interest rate, the one banks charge each other, influences every other interest rate in the economy. Mortgage rates, car loan rates, credit card rates, business loan rates, savings account rates. All of them move based on what the Fed does with this one number. Let me paint you a picture. It's 2021. The Fed has kept interest rates incredibly low, near zero. They did this to stimulate the economy after the pandemic. What happens? Mortgages are cheap. You can borrow money to buy a house at 3% interest. People flood into the housing market because borrowing is so affordable. Demand for houses skyrockets. And what happens when demand goes way up but supply stays the same? Prices explode. Houses that cost $300,000 suddenly cost $500,000, $600,000. People are getting into bidding wars, waiving inspections, offering $50,000 over asking price. And here's the cruel part. You saved up for a down payment. You did everything right. But while you were saving, the Fed's low interest rates made borrowing so cheap that everyone rushed in at once. And your down payment that would have bought you a nice house 2 years ago now barely covers a starter home in a questionable neighborhood. The Fed's decision to keep rates low made buying a home harder for you, even though they thought they were helping. But wait, it gets worse. Fast forward to 2022 and 2023. Inflation is raging, everything costs more. The Fed realizes they created too much economic activity, too much money chasing too few goods. So what do? They crank up interest rates, fast, from near zero to over 5% in less than 2 years. Now suddenly, if you want to buy a house, your mortgage rate isn't 3% anymore. It's 7%, maybe 8%. On a $400,000 home, that difference in interest rate costs you hundreds of thousands of dollars over the life of the loan. Same house, same you. But the Fed changed the rules of the game. And now you're priced out completely. This isn't theoretical. This is exactly what happened to millions of people. They watched from the sidelines as the Fed's policies first inflated home prices, then made borrowing too expensive to afford those inflated prices. A whole generation effectively locked out of homeownership because of decisions made by people they've never met. But here's what makes this even more insidious. The Fed's interest rate decisions don't just affect your ability to buy a home, they determine whether you even have a job. This brings me to the second thing you need to understand. What I call the employment throttle. The Fed has what they call a dual mandate. Keep prices stable and maximize employment. Sounds noble, right? But here's the uncomfortable truth. The way the Fed maximizes employment is by deliberately causing unemployment when they think it's necessary. Let me explain how this works. When the economy is growing too fast, when inflation starts rising, the Fed raises interest rates. This makes borrowing expensive. Businesses can't get cheap loans to expand. They stop hiring. Some start laying people off. Consumers can't borrow as easily. They spend less. Demand for products drops. More businesses struggle. More layoffs happen. This is by design. The Fed calls it cooling the economy. What they really mean is making people lose their jobs until spending drops and inflation comes down. Think about that for a second. There are people sitting in a room deciding that unemployment needs to go up? That some percentage of the population needs to lose their jobs? For the greater good. And it's not random who loses those jobs. It's not the people making the decisions. It's regular people. Often the most vulnerable. The last hired, first fired. People living paycheck to paycheck who can least afford to be unemployed. In 2022 and 2023, you saw this play out in real time. Tech companies laying off thousands of people. Startups running out of funding. Hiring freezes everywhere. Why? Because the Fed made capital more expensive, made growth harder, and companies responded by cutting their biggest expense. People. Your job security, your ability to get a raise, your company's willingness to hire more staff, all of it is being manipulated by the Fed's interest rate decisions. You think your boss decided to freeze hiring because of company performance? Maybe, but more likely, it's because the Fed made borrowing expensive and your company couldn't get the funding it needed to grow. You didn't get fired because you weren't good at your job. You got fired because the Fed decided the economy needed to slow down. Now, the third lever the Fed pulls is something most people never connect to their daily lives. I call it the invisible inflation tax. Remember how I mentioned the Fed creates money? Well, here's what they don't tell you about that process. When the Fed creates new money to buy government bonds or inject cash into the economy, that new money doesn't just appear without consequences. It dilutes the value of every dollar already in existence. It's like if you owned 10% of a pizza, and someone just made the pizza bigger but didn't give you any of the new slices. You still have the same size slice, but it's now a smaller percentage of the total pizza. That's what happens to your dollars. The Fed creates new money. You don't get any of it directly. But now, there are more dollars in the system, which means your dollars buy less. This is inflation, and it acts like a hidden tax on everyone holding cash. Think about your savings account. Let's say you have $10,000 saved up. You're earning maybe 0.5% interest if you're lucky. But inflation is running at 5%. That means your $10,000 loses $500 of purchasing power every year. It still says $10,000 in your account, but it buys what $9,500 would have bought last year. You lost $500. Nobody sent you a bill. Nobody took money out of your account. But the Fed's money creation made your savings worth less. This is why people say inflation is a tax. It's a transfer of wealth from savers to borrowers, from people who hold cash to people who own assets. And here's the cruelest part. The Fed does this intentionally. They have an inflation target of 2% per year. They think a little bit of inflation is good for the economy. What that really means is, they think your savings should lose 2% of their value every year, on purpose. Over a decade, that 2% annual inflation cuts your purchasing power by almost 20%. Over a career, it's devastating. Your carefully saved emergency fund, your cash reserves, slowly becoming worthless. And most people never realize it's happening because the number in their bank account doesn't change. But what that number can buy silently evaporates. But here's where it gets really interesting. The fourth way the Fed controls your life. What I call the asset price distortion. When the Fed creates lots of new money and keeps interest rates low, that money has to go somewhere. It flows into the economy looking for returns. And where does it go? Into assets, stocks, real estate. Anything that might generate a return better than the near-zero interest you'd get from a savings account. This creates artificial demand. Prices for assets get pushed up not because those assets are fundamentally more valuable, but because there's more money sloshing around looking for somewhere to go. If you own assets, this is great. Your stocks go up, your house value increases, you feel richer. The Fed calls this the wealth effect. People feel wealthier so they spend more and stimulate the economy. But if you don't own assets? If you're just starting out, trying to save up to buy your first home or start investing? You're screwed. Because the Fed's policies have pushed asset prices to levels that have nothing to do with their actual value. You're trying to get into a market that's been artificially inflated. This is what happened over the past 15 years. The Fed kept interest rates low for a very long time. Money flooded into stocks and real estate. Prices went to the moon. If you already owned a home, congratulations, you got richer without doing anything. If you owned stocks, same thing. Your 401k looked amazing. But if you were young, just graduating college, just starting your career, you were trying to enter a market where everything costs 3 times what it should based on fundamentals. The Fed's policies directly widened the wealth gap, made the rich richer, and made it harder for everyone else to build wealth. And here's what nobody wants to admit. The Fed knows this happens. It's not an accident. It's a feature of their strategy. They boost asset prices to make wealthy people feel richer and spend more. But that comes at the cost of making it harder for everyone else to acquire those assets in the first place. Now, the 5th thing you need to understand, and this one might blow your mind, it's what I call the boom and bust machine. The Fed doesn't just influence the economy, they create the very cycles of boom and bust that throw your life into chaos. Here's how it works. The economy is slowing down. Maybe we're in a recession. Unemployment is high. The Fed panics. They slash interest rates, make borrowing super cheap, pump money into the system. This creates easy money. Businesses borrow to expand. People borrow to buy homes and cars. Speculation increases. Asset prices rise. Everyone feels great. We're in a boom. But here's the problem. All that borrowing and speculation isn't sustainable. Eventually, it creates imbalances. Inflation starts rising. Asset prices get ridiculous. Bubbles form. The Fed looks around and realizes things are overheating, so they slam on the brakes, raise interest rates, make borrowing expensive, suck money out of the system. The boom turns into a bust. The businesses that expanded, many of them fail. The people who borrowed heavily, some can't pay their loans. Asset prices crash. Unemployment spikes. We're in a recession. And what does the Fed do? They slash interest rates again, and the cycle starts over. This boom and bust pattern isn't natural. It's not just how economies work. It's created by the Fed's constant tinkering with interest rates and money supply. They overstimulate, then they overcorrect, then they overstimulate again, and regular people get whipsawed by these cycles. You lose your job in the bust. You can't buy a home during the boom because prices are too high. You finally save up some money and then inflation from the next boom destroys its value. Your entire financial life gets jerked around by these cycles, and the Fed is the one creating them. Let me tell you about 2 people who lived through one of these cycles. First, there's Alex. Alex graduated from college in 2008 right into the financial crisis. The worst possible timing. The economy was collapsing. The Fed had kept rates too low for too long in the early 2000s. People borrowed too much. A housing bubble formed, and then it all came crashing down. Alex couldn't find a job in his field. He worked retail for 2 years, fell behind on student loans, couldn't save any money, watched as his friends who graduated just a few years earlier were buying homes and advancing their careers while he was stuck. By the time the economy recovered and Alex finally got a decent job, he was years behind. And then, another problem hit. The Fed's response to the financial crisis was to drop rates to 0 and create massive amounts of money. This caused asset prices to soar. By the time Alex had enough money saved for a down payment on a house, prices had doubled. He was priced out again. Alex did everything right. Went to college, worked hard, saved when he could. But the Fed's policies, first creating a bubble, then responding to its collapse by creating the next bubble, kept him perpetually behind. Now let me tell you about Rebecca. Rebecca graduated the same year as Alex. Same situation. But Rebecca's parents understood how the Fed's game worked. They told her something crucial. In a world where the Fed constantly creates money and manipulates interest rates, you can't just save cash and work hard, you have to own assets. So Rebecca did something unconventional. Instead of trying to save up for a big down payment, she scraped together just enough for a minimal down payment on a small condo in 2010. The market was still depressed. Rates were low. She bought the condo. It was a stretch financially. But here's what happened. As the Fed kept rates low and created more money, asset prices rose. Her condo doubled in value over 5 years. She sold it, used the profit to buy a bigger place. That appreciated too. By 2020, Rebecca owned a nice home with significant equity, not because she earned more than Alex, but because she understood that the Fed's policies favor asset owners. Same starting point, same economic conditions, completely different outcomes. Here's what most people don't realize. The Fed's control over your life isn't about conspiracy or manipulation for evil purposes. It's about a system that has built-in winners and losers. The system favors people who understand how it works, who own assets, who can borrow when rates are low and invest that borrowed money into things that appreciate. It punishes people who do what they're told, save cash, avoid debt, work hard and hope it's enough. In a world where the Fed constantly creates money, holding cash is financial suicide. In a world where the Fed manipulates interest rates to create booms and busts, timing matters more than hard work. This isn't fair. It's not meritocratic, but it is reality. The people who succeed financially aren't necessarily smarter or more deserving. They just understand the game. They know the Fed will keep creating money. They know rates will stay low until they suddenly spike. They know asset prices will be artificially inflated by monetary policy, and they position themselves accordingly. Here's the thing. The Fed operates with the best intentions. They're trying to manage an incredibly complex economy, prevent depressions, maintain stable prices, keep people employed. But their tools are blunt instruments. Interest rates and money creation affect everyone differently. And the way the system is designed, some people benefit enormously while others get crushed. The people who benefit are those closest to the money. Banks and financial institutions who get access to the Fed's cheap money first. Wealthy people who own assets that appreciate when money is created. People who understand how to leverage debt when rates are low. Everyone else is just trying to survive in an economy where the rules keep changing. You can't stop the Fed from manipulating interest rates. You can't prevent them from creating money. You can't vote them out or opt out of the system. But you can understand what they're doing. You can recognize that inflation is a feature, not a bug. That holding cash long-term is a losing strategy. That asset ownership matters more than ever. You can learn to read the signs. When rates are low, that's when you want to borrow and invest. When rates start rising, you need to be more cautious. When the Fed is creating massive amounts of money, you need to own things that will appreciate with that money creation. This knowledge doesn't guarantee success, but ignorance almost guarantees failure. Look, I know this sounds bleak. The idea that your financial fate is partially controlled by an unelected group of economists making decisions in closed meetings, that the system is rigged in favor of asset owners and against savers. But understanding this is empowering, because once you see how the game works, you can play it differently. You stop keeping all your emergency savings in cash and start thinking about how to preserve purchasing power. You understand why investing matters, even if it feels scary. You recognize that timing your entry into markets based on Fed policy can make a huge difference. The Fed's influence over your life is real. Interest rates determine affordability. Money creation causes inflation. Their policies create boom and bust cycles. All of it impacts you directly. But that influence isn't destiny. It's context, the environment you're operating in. And once you understand the environment, you can adapt. The people who thrive financially in the modern world aren't ignoring the Fed. They're paying attention, reading the signals, adjusting their strategy based on what the Fed is doing. They own assets during money creation. They borrow when rates are low. They protect themselves from inflation. They understand that working hard isn't enough anymore. You have to work smart within the system that exists. The Fed will keep pulling its levers. Rates will rise and fall. Money will be created and destroyed. Booms will turn into busts and back into booms. The question is whether you'll understand what's happening or just feel confused about why your money situation never improves despite your best efforts. Once you see this, you can't unsee it. Every Fed announcement, every change in interest rates, every news story about monetary policy, it all connects directly to your financial reality. The Fed controls more of your life than you probably want to admit, but that control only works if you don't understand it. Knowledge is power. And now you know.